If your spouse already answers your business calls, keeps your books, or rides along on jobs, and you've never put them on payroll, you might be walking past one of the simplest tax moves available to a small business owner. Quick note before we get into it: I'm an AI avatar of Askia Roberts, a licensed CPA. Every word here was written and approved by the real me. A lot of owners assume paying a spouse through the business is pointless since the money stays in the same household either way. That assumption is usually wrong. In this video, the myth behind it, how the mechanism actually works, an illustrative range of what it can be worth, and who this move isn't built for. Here's the myth: paying my spouse doesn't save anything. It's the same money in the same household. That's the reasoning most owners use to skip this entirely. And on the surface, it sounds right, but it misses what actually changes when a spouse becomes a real documented employee instead of an unpaid helper. This isn't about moving cash from one pocket to another. It's about converting expenses your household already pays: health insurance premiums, out-of-pocket medical costs, even retirement savings, from money spent after tax personally into money the business may be able to deduct, because now there's a legitimate employee on payroll receiving those benefits. The household spends roughly the same amount either way. What changes is whether that spending happens before tax or after it. Here's how it actually works in general terms. If you run a sole proprietorship or a single member LLC taxed as one, and your spouse becomes a genuine W-2 employee, real hours, real duties, real pay, you may be able to set up what's often called a Section 105 medical reimbursement arrangement. The business reimburses your spouse employee for the family's health insurance premiums and qualifying medical expenses. Because the spouse is an employee, not an owner, those reimbursements can be deductible to the business and generally tax-free to the family, sidestepping limits that otherwise apply to self-employed owners buying their own coverage. In a corporation, putting a working spouse on payroll can also open the door to retirement plan contributions and other benefits tied to employee status, not ownership. Let's put an illustrative range on this. Not a promise, because your number depends on your health costs, your business structure, and your profit. For a household combining reimbursed health insurance premiums, routine out-of-pocket medical costs, and a modest retirement contribution run through payroll, the typical value of structuring this properly can land somewhere between $3,000 and $12,000 a year in reduced tax. Higher some years, lower others, depending on medical spending and how the business is set up. It's also not usually a one-time benefit. Done right and maintained correctly, it can repeat every year the arrangement stays in place. But it only holds up if the paperwork, the payroll, and the actual job duties are real, which is exactly where owners tend to get this wrong. Now, the caveat, because this isn't automatic and it isn't for everyone. The IRS looks hard at family employment arrangements, so your spouse has to be a bona fide employee: real hours, real duties, reasonable pay for the work, proper payroll with withholding, and documentation to back it up. A no-show job on paper doesn't hold up under scrutiny. This also plays out differently by entity type. In some S-corp structures where your spouse is also an owner, family attribution rules can complicate or block certain benefit plans entirely, so a mechanism that works cleanly in a sole proprietorship may not translate the same way once you've elected S-corp status. And if your business doesn't generate consistent profit, the administrative cost of running real payroll may not be worth it yet. This is a fit question before it's ever a savings question. Quick ask before we get to the link. If this is useful, go ahead and subscribe. We post one of these every week. This plays out differently depending on what you run: a healthcare practice, a trades or contracting business, and a professional services firm. Each hit different rules on entity type, payroll, and benefit plans. The link in the description goes to the right one for you. Just tell us what you run.
That owner from the beginning wasn't wrong to wonder if it was even worth it. They just didn't have the numbers yet. Once the arrangement was set up properly, real payroll, real duties, real documentation, what used to be an unpaid helper became a legitimate business. and a chunk of the household's own health and retirement costs started working in the business's favor instead of just draining the checking account. You need about 15 minutes and the right numbers for your specific business. That's what's waiting behind the link below.